and welcome to Navigating the Cycle. So, recent years, the investment landscape has changed dramatically. Higher rates, persistent inflation, and geopolitical uncertainty are forcing investors to rethink where and how we allocate capital. I'm very delighted to be joined by an excellent panel today, covering a range of asset classes and a range of different regions. So let's start with some brief introductions. I'm Katie Sunderland. I'm a founding member of Vision Edge One. We're an infrastructure private equity firm with a mid-market pan-European investment strategy delivering sustainable value creation. And Alex?
Yeah, well, thanks for being here. I'm the chairman of CVC DIF in the DACH region, which is the infrastructure product of CVC. And before that, I was a board member of Deutsche Bahn, namely the CFO, and responsible for all of their passenger and transport activities, Schenker, Arriva, and DB Cargo. I have sit on the board for Arriva, for an investor who acquired this asset, and besides that, sitting on a number of other boards, like for the German Reitmann family that owns Paris-based Transdev, Remondis, the recycling company, etc. Pleasure to be here.
Thank you.
And thank you as well. I'm Boris Okuliar. I'm the Chief Strategy Officer at Corinthia Global Management, which is a newer firm that I guess I'll discuss some of our views about the world here shortly, but it's a pleasure to be here. Prior to this, I spent about a decade at Ares Management, where I was co-head of our global liquid credit business. And before that, I was at the Carlyle Group within its credit business. So thank you.
Pleasure to be here. My name is Jad Elon. I am a managing partner and head of the Middle East at Brookfield. We started the Brookfield business 8 years ago. Today, we have assets under management of $17 billion, just invested in the GCC. Globally, we're a $1 trillion alternative asset manager focusing on real estate, infrastructure, renewables, and private equity.
Good afternoon, everyone. My name is Elias Korosis. I'm a fund manager by day with Federated Hermes, which is a cross private markets platform, as well as a global listed asset manager. And by night, I also lead an association. These days, we have Invest Europe, which is the world's largest private capital association, which I have the joy to chair this year. So happy to discuss the Europe angle in particular in this piece.
Great, thank you all. So let's start with setting the macro context, where we are in the cycle and how you would characterize the current environment. And given the GCC theme of today, it would be great to start with Jad for a view from the ground.
So I never underwrote drones in any deal that we were looking to do. And so, look, the first thing I will tell you, and I just flew in from Dubai last night, is it's completely overstated what you're reading in the news. Hopefully that doesn't come as a shock to many of you. But let me give you a few statistics, because we are the largest, if not one of the largest foreign investors in the region. Our businesses today represent 75% of every payment in the UAE. We're 25% of the whole education system, because everyone goes to private schools. We own all those schools. We also see 80% of all the gas flows, because we're invested in the national gas pipeline. And we have $6 billion of real estate, which houses pretty much every multinational that you can think of. Just yesterday, I had an update call on our schools. Every resident is back, and they've been back since the ceasefire was announced. And we are tracking on 90% re-registration rates for next year, which means families aren't really planning on leaving. I mean, you've always got a bit of a 10% delta over the summer. Our payments business, again, 75% of the whole market. Domestic spend is up 3% versus last year, week on week tracking. The biggest hit to the economy has come in the form of, unfortunately, as you all know, we don't have a lot of travel coming into the country, to the region. And I think there's two aspects to that. Number one, You've got families who used to come and enjoy all the beaches. They're obviously sitting there reading the Daily Mail, and they get a bit worried about that. The second part is business travel. Believe it or not, the majority of insurance agencies are not insuring professionals to fly to the GCC, which is obscene. But it's the reality on the ground. It's the exact same reason to why ships are not flowing through the Strait of Hormuz. So the difference really is, I would say, bifurcated between residents and tourists. Now, the one thing I will say though is, despite all of this, the IMF's revised projections are that the UAE and Saudi will grow 3 to 4% this year and over 5% next year. So we're not talking about a recession, which is crazy when you come to think about it. Because everyone's mindset is, oh my God, it must be empty, but it's not. And if I put my, I wear many hats, but if I put my real estate hat on, if there was ever a time to double down on real estate in Dubai, now's the time. Because I grew up in Dubai, and I can't tell you how many conversations I've been with people that say it's a transient city. Everyone used to say one bomb and everyone will run away from the country. Well, we've had 3,000 and everyone's still there. So we actually just announced a deal 3 weeks ago, the first after the war, the ceasefire had been announced, and we continue to deploy.
Thank you, Jad. That's great to hear. And maybe we can zoom out for a broader view from Boris.
Sure. Well, first of all, it's great to hear the positive news flow from an expert on the ground in the region. So that's always a fantastic update to be getting front and center. If we look at it, I think from a more global perspective, starting west and then moving east. Obviously, we live in some very interesting times. What's happening in the U.S., both domestically and globally, in terms of trying to rewire some of their policies and the way that it impacts global trade, the tariff wars that are going back and forth. There's clearly an evolving struggle politically to try and rein in some of the early moves that were made by an administration. As recently as this morning, I think the Senate announced that they had actually voted in favor of curbing some of the war powers of the executive, and so that's obviously something that's pretty monumental when you think that the House and the Senate are both controlled by the same party as the executive. So there is some tempering that is starting to come through. In the meantime, if you look at the statistics underlying, whether it's inflation, whether it's consumption measures, things are ticking along pretty well. The consumer balance sheet's starting to get a little bit strained. Corporate balance sheets are finally starting to see the impact of rates increasing. So there's a little bit of stress that's coming through the market. There's still some concerns around retail flows from some of the private credit funds that are out there. So a lot of that noise is dampening some of the deal volume that had been expected to be seen in the U.S. year to date. But if you look at the broader backdrop and you think of that versus the last 20, 30 years, any given point in time of that, it would normally indicate a large drop or disruption. I don't want to say anything panicky, but clearly a little bit more of a reaction than what we are seeing at the moment. It's almost as if people have become numb to what they're seeing around them and are pretty comfortable in terms of what's going on around the world. From the European perspective, and I'm sure that the colleagues here will talk more about this, so I don't want to steal their thunder, but there does feel like there is an absolute tailwind that's coming through Europe from an economic knock-on perspective. Again, you're not seeing, Jad mentioned this, and I think he's right, not just in that region, but more broadly, you're not seeing recessionary pressure. You're actually still seeing fairly broad-based expansion, but inflation and monetary policy are clearly having an impact on the consumer and on some of the habits that we're going to be feeling, I think, for the coming few years. If you continue going, further east, Chinese economy is still proving to be very resilient. Indian economy is proving to be resilient. Japan is kind of having a moment again where their curve is actually pretty steep. On the 30-year end of the Japanese government bond curve, They're actually above Germany at this point, and so there's a renewed interest in investment domestically there. There's capital flowing in there. So you are seeing real economic activity that somehow, with all the noise and all the cameras pointed at what's going on in the Middle East, even from the folks on the ground and then more broadly, things still seem to be progressing at a pretty comfortable pace, and we're taking some comfort in that, but trying to be cautious around it.
Great, thank you, Boris. And now to continue that focus that you guys bring on Europe, Elias, maybe you can answer with a view to Europe.
Yeah, and I'm a big fan of Europe, and as you would expect,
I hope so.
And it's come really into the spotlight in the last few years. Actually, interestingly, when I was campaigning to get the chairmanship of Invest Europe, I actually campaigned on a basis of promoting private equity as an asset class. And then the Trump election happened. I'm like, okay, we got to change the agenda completely because it's all now about why Europe. It went through ups and downs. And the why Europe part has become, in my 20-odd years of being in the market, I have never seen the tailwind, as Boris called it, so strong for Europe. I was in an event in Singapore not long ago. Everybody was talking about rebalancing their portfolios, re-looking at Europe. Everybody rediscovers the benefit of being a global investor versus essentially having 70% of your capital in the US. And to me, that when you're looking at investment topics, what I always start with is first get the trillions right? Look at the very big picture and make sure that your allocation at the top level makes sense. And we've had a picture that was in most people's portfolios, if you look at it across and I can speak for private equity in particular, my colleagues can speak to other asset classes. But for private equity, most people would have been concentrated in the US. US has done phenomenally. The US dollar was very strong. So, that kept giving it momentum. And now everyone saw that, you can't tell when things will start moving in terms of the sentiments between regions. And which is why you have diversification. Diversification is for the unknown unknowns. You never know when the next war is going to happen, what is going to happen. And then Europe is a deep market that offers a tremendous depth of opportunity. And that's what people, I think, underestimate because people get oriented to what the headlines are. The headlines are typically like, where's market capitalization? Right, and so market capitalization is whatever X% in the US, a fraction of that in Europe, and so they orient that way. In terms of opportunity, depth of opportunity, like millions of SME companies, for example, that is the real bread and butter of private equity. The numbers are actually very similar. So one of my first, when you're actually looking at it as an investment thesis, the data isn't there to support that you should have a different allocation between the US and Europe, if you actually look at it objectively. So that, I think people are waking up to this. There's a lot more interest in the region as a result. The whole cyclical thing, obviously Europe came under a lot of pressure when the oil prices started coming up because people said, well, Europe doesn't have its own oil production, so what happens there? But actually, structurally, has given a phenomenal push for sustainability investments. I was talking to Paul Pullman last week, who I was trying to get to, hopefully we'll speak to at our next event in March in Geneva. And Paul, who's a former CEO of Unilever, was saying, I've never seen such a boost to sustainability since Trump came on power. Because essentially everything that has happened has made the plays, sustainability plays, a lot more easy to argue for. And in Europe, it has made the political class become aligned with the investor class in terms of we got a multi-trillion gap, we got to plug this. So defense, sustainability, all those aspects are, I think, starting to turn on the tap for funding. What we still have to deal with is the exit markets, and that's my biggest focus point. But I'll stop here because I can keep talking about Europe forever.
Thank you, Elias. And that certainly resonates with what we've seen fundraising, that there is renewed appetite and interest in Europe, even though it is often seen as a slower growth region. So do you think that Europe is benefiting temporarily from geopolitical shifts, or are we witnessing a structural re-rating of the opportunity set? And Alex, over to you.
Down to Germany, right? So let me be a bit more provocative here. And I think the theme is Germany the sick man of Europe again? And of course, you cannot think about Europe without Germany. You probably can't think about some of the world trade export nations without Germany, as by now having slipped to number 4 in the world. And I think therefore it's symptomatic. Now, Germans tend to think a bit negative about what's going on. I actually think there is lots of opportunities, and infrastructure has been mentioned previously, clearly a sector that I'm focused on, but also beyond infrastructure, there's lots to be done. And this is maybe not so much the financial view, more the operator's view. And if you look at what I'm doing, this is probably a model, but still a test. How can private capital, and that includes, of course, venture capital, PE, infrastructure, credit, real estate, etc., create value in the future with sort of expanding a bit to more the operational side, right? Money is more than enough out there. We are all raising big funds, and if money is out there in huge magnitudes, then it becomes more a people's business again. And if leverage maybe doesn't yield your returns, then it's about operational excellence. So this is a bit my focus. I could sort of draw a matrix across Europe, across Germany in terms of asset classes. I do believe credit, despite all of the noises in the press, is extremely important for Europe, specifically for Germany, as we are so heavily relying on the bank side, right? And this is not sustainable. The withdrawals from the credit funds, well, I mean, look at the bank's depreciation ratio. It's, in normal years, 2%, 2 to 3%. So I'm not worried at the end because the credit quality is rather good. Real estate is suffering. I think that is very, very obvious. Also in sectors that I liked for long term, like student housing, like self-storage, which is a developing sort of sub-asset class. Business services is booming. So I could give you many examples where the focus should be, but probably infrastructure is the overriding topic in Germany and in Europe. But keep in mind, there is, at least from my point of view, no such thing like Europe. Because if you want to testify a product that you have developed in Germany, well, you need to go through very lengthy processes in France, in Spain, in Italy, etc. So the single European market is still not at a place where it should be after all of those years. And we celebrated, I think, the 30th year or anniversary of the single European market 2 years ago. But there is still a long way to go. Defense, right? I mean, there's only one example, I believe, of a pan-European defense collaboration, and this is Airbus, Thales, Leonardo, and I'm touching now on a number of points, but I think this, rather harsh challenge that Europe is facing offers so many opportunities beyond pure financial investment. So we need to focus a bit more on strategic direction, strategic investments. Government, I think, needs to become a more clear view on what is important for the future. And this is not only Germany, this is Europe, this is every single country, of course, at a different pace. So I could continue forever, but I'm actually very positive on a number of things. Maybe the last point is that Europe will not, contest with the Americans, with the Asians on the big AI tools. Clearly not, right? Energy is too expensive. We are too fragmented, but where we can actually excel is in terms of the applications. Europe is fantastic in terms of manufacturing excellence in niches. And by niches, I mean, a niche of 10, 20, 30 billion in terms of market size. Application matters. Goods need to be produced and not just to analyze data. So that's maybe my final point.
Thank you. And as we start thinking about the opportunities, it'd be great to hear from each of you where you're currently deploying capital with the highest conviction and what gives you confidence in those sectors or regions in spite of the volatile macro backdrop. So perhaps we can start with you, Boris.
Yeah, sure. We are actually pretty balanced in our view, just being focused on core mid-market direct lending at the moment between the US and Europe, I think with a little bit more of a bias toward deployment in Europe, given some of the opportunities that we're seeing. Structures here tend to be a little bit more conservative. I think since the pullback, particularly on the retail side in the US, it's created some spread widening opportunity and some additional deployment opportunities that we weren't really seeing as much of before. Europe was a bit more insulated from that, but there's been some knock-on in terms of some of the spread widening in particular sectors that impact services that have software underpinning. I'm sure that everyone has been very focused on that, but we do like defensive services businesses. We still are a bit more focused on Western Europe, whether it's Germany, Nordics, Benelux, UK a bit, France a little bit more. But we do see a lot of really nice opportunities within those marketplaces. And the fact that there's been a little bit more of a scarcity of capital flowing into sectors like software and being a younger firm where we have more fresh capital available, it's been an opportunity set for us to step in when something has a services or a software underpinning that is mission critical, that is not at the same risk levels that you might see from some of the other AI risks that are being highlighted around the marketplace, and there are fewer people willing to deploy capital into that space. It creates a nice investment thesis and lets us put money to work at pretty attractive returns. So, not saying that that's the only thing that we are focused on, but we tend to shy away always from heavier cyclicals. We'll do some of the manufacturing stuff, but it has to be very specialized or have some clear niche purpose to it. But as Alex said before, we think that credit is a pretty nice place to be at the moment. If you can command a good risk premium on your spread, and if you're doing it within the private sphere and you have some illiquidity premium attached to that too, and then the level of equity that's being contributed into these businesses from sponsors at the moment, and some of the other opportunities that is affording, particularly from a consolidation perspective, we just think it's a really nice time to be investing.
Great, and Jad?
So at Brookfield, it's the spectrum is very wide because we're investing across four key sectors. But the one thing that transcends all of those sectors that we're investing in is we try as much as possible to invest in the backbone of any economy. And so if I look today at our renewable energy transition business, we're helping one of the countries in the Gulf actually help fix their electricity grid. As you may know, in the summer we use a lot of air conditioning and electric grids get overwhelmed. And so utility scale batteries are going to become a very big part, I think, of every grid globally. Forget just in the GCC. I think that's a trend that's going on everywhere. On the infrastructure side today, we're already invested in the gas pipelines of the UAE with Abu Dhabi National Oil Company. I don't think it would be a stretch to say today that there's going to be a lot of expenditure in expanding energy infrastructure to bypass the Strait of Hormuz, and so that's something that we're keeping a close eye and discussion on. Very interestingly, like I just mentioned, the war basically pared back what was going to be 5-6% GDP growth in the GCC to effectively 3%. And so what that means is we still are growing and we're still backing businesses that are growing. And so in the private equity space, our business actually there has gotten so big that we've created pockets of capital that are fully dedicated to the GCC. So we've raised now a $2 billion private equity fund. Funnily enough, the majority of that got signed during and after the war. Of course, after 1.5 years of DD and fundraising process, but every single LP came through because they see the other side of this, which is now is the right time to be buying essential businesses in the region and getting them at fair market value. And then on the real estate side, We have a residential fund dedicated for the region. We've been speaking a lot about diversification, and there's one very important part to diversification that I don't know that we've touched on yet, which is currency. And maybe here in the region, maybe many people don't worry about that because here you're in pounds and in Germany you're in euros, but for people living in Africa, people living in Asia, they are always looking for reserve currencies that they can invest in. And usually the investment decision is driven more by having the currency exposure than the underlying asset. And so what the GCC actually provides is emerging market growth, but in dollar-denominated currency. So if you are sitting in a country in Asia which is feeling a little bit of hostility from the United States today, well, you can get dollar exposure in the GCC. And that's actually what's been driving a lot of our growth. Because with the exception of very few countries, we have very good relations with everyone else in the world. And so I expect that the China's, Japan's, everyone in that side of the world is going to be a very big investor in our part, and we're effectively going to try to sell to them in the future.
Very interesting dynamic. Thank you, Jad. Alex?
Yeah. Well, there were a couple of points that got me going, and one clearly is that investors always invest in the backbone of the economy. I think this is very, very true. Now, traditionally, PE, at least in Germany, has invested into auto and chemicals. So let's see when, private equity has to do market-to-market valuation, how that works out in the portfolios. But equally, infrastructure is always the backbone of an economy, which clearly is, one of my topics here. Well, maybe one more thought is that, of course, we have a mandate by our investors. And talking for CVC and even more so CVC Div, there's clearly a European mandate, right? To invest in Europe, getting regional exposure and getting, of course, euro exposure, which is a bit different for some of the other funds. So talking a bit about infrastructure, which by now has, a huge bandwidth and a huge definition, right? From the traditional transport, logistics, passenger transport, railroad, now to energy, obviously, social infrastructure, education, etc. Now, one needs to be a bit careful because some bubbles also have been created in infra. If you think about fiber with some probably not correct assumptions around the future growth, but we are looking clearly into Europe, which includes Eastern Europe, similar to what you said, but maybe slightly different in terms of the subsectors. So renewables, of course, we are invested. We don't really have a wind investment so far, and one probably should carefully think how that pans out. Just looking into Shell, BP, who have cancelled actually 2 large investments in the North Sea. We are invested on the grid side, a lot on the passenger side. So if you think about rail, passenger transport, some of that infrastructure is highly, highly interesting. Education, to leave the obvious investment areas aside, to me is extremely interesting, but in a way challenging. I think it's a direct impact of AI. We will see many people leave the job market, and then the question is how to train and educate them. Because I personally don't believe in the Silicon Valley's model of everyone gets a defined income. People need a purpose, right? So therefore there is a huge job to do between the government and the private sector of training and extending capabilities of people. So I think these are probably some of the points or some of the subsectors we are looking into.
Yeah, I'd love to come back to some of those, but also first we'd love to hear from Elias where you're deploying capital with conviction.
Thanks. So I won't go through the entire heat map because we'll be here all day, but I would focus on a couple of things. One thing is on size. We have made a hard conviction call on going way down market in private equity, and so focusing very much on the lower end of mid-market, and also working a lot with independent sponsors. So we are manager-led in our approach, so we work with other people, co-invest alongside them, co-sponsor deals, and independent sponsors in Europe in particular is a very interesting segment that's coming up quite fast. In the US, it's a very deep market. In Europe, it's happening now, and it's actually a new segment we've onboarded on Invest Europe. So independent sponsor, emerging manager-led transactions in the lower mid-market and in interesting geographies as well. So pricing is fairly efficient. So we actually try to go to places that are not the hottest places in the marketplace. We've done quite a lot on CEE in Europe, and it's doing quite well. To your point, I remember approving deals in Turkey when things were looking really, really difficult. And actually, when you're investing in lower mid-market, where a lot of the value creation is very idiosyncratic to the company, as long as you can get over the currency part, and the company has that ability to do that, you can get over these the bigger issues. So we really like that kind of lower mid-market play, and in more interesting off the beaten path geographies.
Thank you. And picking up on the theme of AI that Alex brought up, because every investment conversation today must touch on AI. So the digital infrastructure and the energy generation requirements need so much CapEx. And yeah, it's a huge space. So where do you see the most attractive opportunities within that context?
Well, as I brought it up, right, let me maybe give it a go, and that might be, again, a bit provocative. And let me push that out. I don't see actually any reason to build huge data centers in Germany. And that's a broad and bold statement, and you could ask the question, why is that? Well, it is because the energy costs, obviously, in Germany are the highest in Europe, 30-40% above similar energy rates, point 1, point 2. So that implies you should go closer to where energy is much cheaper. You could think about Norway, right? And there are actually some very interesting projects in Norway, as water is much cheaper, and transferring data has a cost, of course, but it's at the end much cheaper. Of course, political dependencies, and we had some discussions in Europe whether Norway is supplying gas to other European countries, but that makes more sense in terms of capital allocations than building huge data centers in Germany. The other point is, if you follow my argument, we won't train language models. We won't train AI here in Europe. It doesn't make any sense whatsoever. But what we should do is focusing on the applications for the manufacturing process for our corporates. Well, then that probably defines a slightly different size and investment amount for how large those data centers should be, right? And the big question is, and I don't think that investors have thought that fully through, because anyone is now investing in data center, and in Germany it's Frankfurt, because it's one of the more interesting dots and knots. But I think it remains to be seen whether, if you don't need the huge data centers, whether corporates go for smaller ones or national solutions. I have seen that. The German Schwarz Group, the owner of Lidl, has done that. Telekom extended their data center near Munich. But the expectation is it will only be half utilized because of that impact, that corporates only slowly using those data centers. So maybe a word of caution. But coming back, it's more about the application, which is different from the US and China, Asia, in terms of our model.
And maybe the Middle East for you, from Jad?
So we've had substantial capacity built out in the Middle East. And I always scratched my head, but the energy part makes a lot of sense to it. It's funny, we've been talking about data sovereignty for a very long time, and that's going to drive data center growth and everything. But I can tell you, I think once you've been through a war, you rethink data sovereignty in some shape or form, because your data centers are attacked. And what you thought was most safe in your own country, now all of a sudden you start to think, well, maybe I should be holding it in some backup places as well. And I think that's going to change a lot of what we're seeing and how these are built. But for the most part, you need to go where energy is cheap, cooling is cheap, and where you have an availability of chips, because not every country is getting all the chips. So if you look at how the GCC has positioned itself, at least Saudi, the UAE, and Qatar are 3 countries that are getting a good portion of chips. And we think that that's going to continue to grow. But there are 2 things we're doing at Brookfield. I'd say number 1 is on AI overall, we will never be the best people at coding the AI. That is not our specialty. We are not that creative. But there's $7 trillion that's going to have to be spent on the infrastructure alone in the next 10 years to get AI up and running to the extent that we need it and to the extent that we're all using it. And so we're focusing, again, on just all the components that are going in there, power being a very big part of that. To go back to something that we were just talking about, there is no grid. There are very few grids in the world today that can sustain the amount of power that is required for AI generation over time, which means for sure you will find energy-independent projects. We own Westinghouse in the United States, which is the largest commissioner of nuclear. 6, 7 years ago, we were thinking that there would never be a new nuclear plant ever recommissioned. Today, we have over 18 that have been commissioned by the US Department of Energy in what is the largest nuclear rollout. And there's one reason for that, and that's AI. The second part where we're playing on AI, and this is off of our balance sheet, because we'll be creative and things, but if it's off of our own balance sheet, we invested in a humanoid company called Figure AI. And the reason why we invested with them is because all the training that needs to happen, we can do it through all of our assets. So humanoids effectively need to act like all of us act on a day-to-day basis. And so what we've done in every hotel that we own in the United States, we've got the housekeeping staff wearing all of these data collection items that then feeds and trains the model in Figure AI. So we think that within the next 12 to 24 months, we may have humanoids helping us out in the house. And that's going to be, in our opinion, game-changing.
Wow, definitely game-changing. Elias, is there exposure in your portfolio?
I'll close out with a couple of points. One is on super micro, one is super big picture. The super micro thing that we are doing, so we don't do a lot of the big ticket items, which I actually I would love to be in the nuclear game and so on, but we're just not in that game, which is a very big ticket game. What we like to do in private equity, where we do, as I said, the smaller end of the market, is invest in real sort of nuts and bolts businesses that are serving the electrification of the grid and so on. So literally, it's kind of a back to basics around like getting, roll-ups of electricians and so on that are serving the substations and doing all this, all the setup. The big picture point is more around trust. And I think that's one word that's going to become super important in anything to do with AI. And as we saw, now people over the last few years saw that, you can't depend on, I guess, the post-Bretton Woods system of international order. So you have to figure out where will you place your trust in terms of institutions. And Europe has shown a very bright light in terms of being a continent where institutions are respected. And I hope that this will also transfer into the data governance world. So my vision for Europe would be that the same way that people feel an element of trust when they're putting their money in Switzerland, that it becomes like the Switzerland of data for the world. Because for a lot of applications, and obviously things will be regionalized, but you still have to figure out when you're looking at cybersecurity, surveillance kind of software and so on, what kind of partner do you want to have? And there's lots of questions now as to whether you can partner with, let's say, a Chinese software company, right? Or now you have the same questions if you have to partner with an American software company that will be dependent for overseeing and managing your most critical data in Europe. So I think there's a huge opportunity around data governance and the whole theme of trust for Europe.
Very interesting. Boris, do you have anything to add on this topic? Otherwise, we'll come on to...
I think that we've heard some very good views. The only thing I think that I would add is that from an asset management perspective or just an overall business perspective, we spend a lot of time analyzing that risk and trying to see how that risk evolves across different industries. Energy source being definitely one of those things. But we also have been rethinking our own business model, and I think that's something that brought a lot of us together, is that how can we actually use that technology to be truly nimble and reactive or proactive in what is now a reactive environment, just given how variables are moving around. And the evolution of the technology has just been astounding and just continues to accelerate. And so it's almost a full-time job to be staying on top of that these days, and I don't think that that's going to be changing anytime soon.
Yep.
I kept it.
Absolutely. And moving on to the final theme that I wanted to explore here, which is about the influence of GCC investors. So they become increasingly influential allocators across private markets globally. So I'm interested in your views on how capital from the region is shaping investment priorities, partnerships, and competitive dynamics today. Maybe we can start off with Alex.
Okay, so that is now truly the German perspective, and I would have seen, or I would see, like a development. I think in the early days, when did the Kuwaitis do their first deal in the German automotive industry? That was, 25, 30 years ago. So I think this was really the beginning of trying to get exposure to some world market leader brands sitting on the table, maybe as well. And that expanded clearly with other sovereign wealth funds, with other investments specifically into the auto industry. Then at the same time, obviously, those funds became LPs, co-investors in many deals. And I would say that then there was a second wave or round becoming a bit more strategic. And I think that was going hand in hand with what was going on at the same time in the Middle East, again, at different paces, sort of on the infrastructure side, on the chemical side, clearly. Recycling, obviously, is a big topic that economies always face. And, I think we are probably now in the middle of which is a very interesting phase. I mean, just think about ADNOC bought Covestro, right? One of the largest chemicals companies in the world in the commodities field, but with an extremely interesting and not easy to copy technology. So what I'm seeing now is that not attaching but expanding existing investments like OMV, which is owned in Austria, extending the product offering, getting the arms around technology and networks. I think networks is clearly something that you cannot recreate overnight, technologies and networks. So I have seen Abu Dhabi once again contesting in the Schenker game when the German government sold Schenker out of Deutsche Bahn, one of the worldwide leading logistics companies. It was a bit too late. Sometimes the Middle East or the Middle Eastern sovereign wealth fund have a bit of an issue adjusting to the more strict European processes, which are different in the US. There they are a bit more open. But it makes a lot of sense. Getting access for economies that are now manufacturing a lot on the consumer side, chemical side, and many others, to get access to global networks. So I think it has become much more strategic, almost in a way like the Chinese would think, like in very long-term cycles, strategic. And then, of course, I'm seeing them a lot in specific transactions as LPs and as co-investors. So I actually think much more strategic than we would think at the first glance.
Yeah. Would you agree with that, Boris?
I do think that he's highlighted a lot of the fine points there. From my perspective, I think just going back 20 to 25 years, the investment that's come from that region has played a huge part in shaping markets today in terms of what constitutes private markets across broad asset classes. And it really has driven a reshaping of thought around a lot of these markets and how capital approaches different situations. And so in many ways, having to think going alongside that longer term vision and strategic growth, as Alex was just mentioning, was, how do we smartly deploy our capital to meet the needs of our countries, our people, make those investments really work for us as well. And in doing so, at the time, if you go back into the early mid-2000s, they were very early entrants in terms of partnering with businesses to approach capital formation and deployment in ways that worked for them and that were not necessarily traditional. And so in many ways bred sort of an alternatives universe that has subsequently followed. So it's been pretty incredible to see that grow and continue to scale and just build upon itself, and what's happened in the region since then. But the person that we really all should be asking this is this guy.
Exactly.
So I'll stop now. And
I don't know that I have much more to add. Look, there's been a huge transformation with these sovereigns over the past 50 years. It's night and day, quite frankly. I think KIA was the first one to set up a foreign office, which was in London in, I want to say 50 years ago. And even till today, they are one of the foremost active LPs, at least that we see from the region. In my business, I have, every single investment I have is in tandem with the sovereign wealth fund from the region, every single one of them. And that's because, as you can imagine, the sovereigns own the best assets. And if you want to get access to them, you have to invest with them. What I have found, though, is they no longer are interested in just investing capital for the sake of it. They want to invest capital with purpose. And that, I think, is what we were alluding to earlier, is that they're using it far more strategically than ever before. If you want them in your fund, you should expect that you're going to get asked that you give up a part of the GP. And the bigger you are, the less likely that happens, but the smaller you are, high likelihood, especially if they're anchoring a strategy for you. And that works for some people and it doesn't work for some people. And if it works, great, they're happy to partner. And if it doesn't, they're happy to look at the next one. And I think the other thing, and someone said this earlier in one of the panels, there will be a splurge of investment announcements coming out in our part of the world. There will be a huge focus on it, but make no mistake. I think you were mentioning diversification and how people look at risk. There was ADIA until today, which is $1 trillion AUM, doesn't have $1 in the GCC. It's all outside. And I don't see that changing either. There may be a percentage change for the next 5 years, but overall, the money's still going to flow everywhere in the world, and they're just going to think about it more strategically.
Great, thank you. Well, it's been wonderful getting a range of perspectives on navigating the cycle and hearing about the compelling opportunities that you're finding. So please join me in thanking our panel.
Thank you.